We've got Chris Robinson joining us this morning, Managing Director at TJAM Institutional Services, to help us take a look at commodities. Chris, welcome. Good Friday morning to you. Crude into its second straight losing week after 7 consecutive weekly gains. It's comfortable into the end of the week, hanging out around this $80 level.
Yeah, a big picture. We've been in basically an 8-month, $20 trading range. Go back and look at all year. Can't get above, when we were just there at 85. And, it didn't take very long to have that haircut. So the market's trying to get through 85. If it does, again, where are we possibly going to go? A lot of it just depends on what's going on with the idea of what's really if China's economy is able to come back. We've seen lower gas demand here in the United States than people had expected. We don't really have a huge oversupply, but I think that's the number one thing. And honestly, it's also too, Phil was talking about the 10-year and stuff. That is really impacting commodities. When the 10-year repriced, and we started talking about that last week, it put some pressure on the commodity, because the whole idea is if the world's going to slow down, it's probably going to put pressure on crude oil. It might not be the right idea, but it's certainly the idea that the herd is looking at right now. Big picture, right? Go back and look at the high, in the pandemic high, it was at $1.30 and change in this current October contract. Then we went all the way down to $63. Spread that out. You know how I like to do the halfway backs. Halfway backs, $97. So that would be probably the upside target for all the bulls out there if you're a perma bull. Not only is that halfway back, but it also would negate all the money that the federal government made when they sold 280 million barrels or 180 million barrels at $95. So that's still lingering out there if you're trading crude. If you're not keeping that in the back of your mind, I think you're making a mistake. At some point, there's going to be a reckoning date for them covering that SPR. I hope they cover it at 65. You've got to ask yourself, what happens if they cover it at 95?
Taking a look here real quick at the charts here, I just want to point to crude oil right now, which just recently failed up around 85. And to Chris's point here, we've been in a range, a $20 range, 63 up to 83, 85, depending on how you want to slice it. I don't want to split hairs, but you can see how we're hovering around just above the 50-day moving average in this range. Extremely mature, basically balancing here around 72, 73, 74 since, we'll call it middle of October, beginning of November of last year. I also have another chart here in terms of a look at the halfway back and where we are in the bigger picture from, well, we're looking at 33 here. We're talking about the lows that we saw back in the fall of 2020 up to the war in Ukraine spike highs up to 130 here. Phil, though, just a bit deeper dive into the comment about, again, the idea that higher rates ultimately, with China kind of providing, limited in terms of that lack of upside momentum and real follow through to the upside or anything to get excited about, I guess is the best way of putting it. Higher rates ultimately is something maybe to be a bit concerned about in terms of dampening some of the demand.
Oh, absolutely. At some point, and that's been, everybody in the U.S. is waiting for the shoe to drop, right? Yeah. We're starting to see consumer credit. We have higher credit card bills. You've got to go get a 30-year mortgage now. It's, some people, if you've got bad credit, they're quoting you over 8%. Yeah. That's no joke. That's going to slow down people. And the third thing is, it's October and all the student loan payments restart. So there's a lot of what ifs out there, what does that mean? Well, people won't have discretionary income. If they don't have discretionary income, they don't jump in the car, they don't go out and have dinner. It's in our U.S. economy, 70% of it is dependent upon the consumer. So that's why it's a worry out there. And, so far, Chairman Powell has been, he's been really hot at the craps table because they haven't had a spike in unemployment yet. That has been the one saving grace. I live in 50 miles north of Chicago, and I was out the other day, and they can't hire enough people at these fast food restaurants. They have $3,000 signing bonuses to come on and work at a fast food restaurant. So that tells you that the labor market, at least around here, continues to be tight, and that has been the saving grace for Chair Powell. The question is, are they going to do it too long? I don't know. But I would say this, it's getting to the point where if something does break, the number one thing they're concerned about is unemployment.
You know, we've been talking a lot about employment, tying it to crude oil prices, ultimately tying crude to the demand narrative. It's all so intertwined right now, it seems like. And then I like it, again, kind of getting back to your initial point there about rates to the upside and demand. It does seem like we've seen this movie before, right? This show before in terms of, yeah, yields to the upside here in this purple line here right now, you can see. But at some point, that does start to weigh on expectations as far as demand for crude. When we get a big run up there, we definitely saw that back in 2018, 2019, where crude started to falter as yields worked their way up to that 3% level. Here again, we're looking at the TNX compared to crude oil, and lots to focus on here when you're talking about this in terms of prices at the pump and the impact this has on us as far as the inflation narrative here. Again, all very much intertwined. And Chris, we appreciate you joining us this morning here, this Friday morning, to take a look here at commodities and talk crude oil here at these levels, comfortable levels around 80. Chris joining us this morning from TGM Institutional Services.